After studying this module, you would be able to know how international equities are issued, know how international bonds are issued, and understand short-term and medium-term instruments. A financial market is defined as a market in which funds are transferred from lenders, that is the surplus units, to the borrowers, that is the deficit units, through the intermediation of various types of institutions. There are number of instruments available to facilitate such transfer of funds. The funds are transferred between parties within the national boundaries or across national boundaries. When funds flow take place between parties within national boundaries of the country, it is called as domestic financial market. When funds are transferred between parties residing in different countries and across national boundaries, it is known as international financial market. An important component of international financial market is international securities market. A borrower can obtain long-term, medium-term and short-term funds in international market through the issue of securities such as international equities or Euro equities, international bonds, medium-term and short-term Euro notes and Euro commercial papers. These sources of funds are shown in figure. Now we can discuss about international equities. A company can finance its operations through the issue of debt and equity. Due to globalization and increased cross-border capital flows, it is possible for the country to raise funds from international markets. When equity shares are issued outside the issuer domestic market, such shares are known as international equities or Euro equities. Euro equities are issued in the form of ADRs and GDRs. A non-US company issue ADRs or the American Depository Receipts to raise equity capital from the US market. ADR is a certificate that represents the underlying shares of the company. It is generally traded in American Stock Exchange or AMEX, New York Stock Exchange or NYSE or NASDAQ. GDRs are issued to raise equity capital from international markets other than US. It is generally traded in London Stock Exchange. These instruments are being more preferred by the issuers as well as the investors. Now let us discuss about benefits of international equities. Both issuers and investors are benefited by the international equities due to some reasons. The reasons of the benefits to the issuers are: the issuer can broaden its investor base by issuing equity on foreign stock exchange. This leads to stability in stock prices of the company. It enables the company to raise large amount of capital from the international market, which would not be possible through domestic market. When a company issue equity in foreign markets, it brings foreign exchange, which is vital for economic development of the country. The issuer has to incur low cost while raising funds from international markets. The cost of international equity is generally 3 to 4% of the issue amount. When the company issues equity on foreign stock exchange, it would be able to gain international recognition in the market. Then there are certain benefits to the investors. Investors do not bear any foreign exchange risk while investing in foreign company shares. Investors enjoy the benefits of diversification. They can increase the return with a given level of risk or lower the risk for a given level of return. The issue procedure of international equities. Different stages are involved in issuing international or Euro equities. The figure describes the process of issue of international equities. When a company plans to raise equity capital in the international market, firstly it decides on various aspects of the issue such as issue size, price, market from where equity capital is to be raised, and about other legal formalities. It appoints a competent lead manager, that is an investment bank, to control and organize the share issue. The lead manager assists the issuing company in deciding the depository, it may be American or global depository, through which shares is to be routed. It gives suggestions on the details of the issue and also examines the risk involved in the issue. After getting the green signal from the lead manager, the issuing company prepares the prospectus and the other documents. It also takes permission from the regulatory authorities. After obtaining the approval, the issuing company deposits the shares to be issued to a custodian bank. Custodian bank is situated in domestic country and is generally appointed by the depository in consultation with issuing company. The domestic custodian bank requests the depository situated in a foreign country to issue the shares in the form of depository receipts. Before the actual issue, the number of depository receipts issued against the number of underlying shares is decided. The market price of depository receipts is influenced by the potential of the earnings, fundamentals of the industry and macroeconomic fundamentals. The depository is a bank appointed by the issuing company to issue depository receipts and located in international financial center. When issuing company provides information to the depository about the launch, then depository issues the depository receipts in the market. ADRs are issued by American depository and GDRs are issued by global depository. After receiving the proceeds of GDRs from the investors, depository transfers it to the custodian bank, which in turn transfers it to the issuing company. The company records the name of the investors in the shareholders register. The investor can surrender the GDRs by giving them back to the depository, who in turn provides the surrendered information to the custodian bank. It then issues the share certificates in exchange of GDRs and sells them. Custodian bank convert the proceeds of sales into foreign exchange and then make payment to the foreign investors. The role of underwriter and listing agent is very important in the whole process of equity issue. It is a lead manager who underwrites the shares and charges a fee. An agent helps the issuing company in filing all the necessary documents with the stock exchange. After the completion of all the formalities, GDRs are listed on the stock exchange. Transactions are settled through the international clearing houses such as Euroclear and CEDEL. GDRs holders do not show considerable interest in the voting rights as they keep changing from time to time. In this respect, different procedures can be followed. Number 1, depository exercise voting rights by entering into an agreement with the issuing company. It can do so either with the majority voters or according to the management wishes. Number 2, it is assumed that depository votes in the proportion in which rest of the shareholders do. Number 3, depository votes according to the instructions given by the management nominee. A large number of documents are required in the process of issuing international equities. These are prospectus, it gives details about the issuer, its management and about the issue. Depository agreement. It is an agreement between the issuer and the depository that describes the rules for conversion of shares into GDRs and back and many other things. Underwriting agreement. An agreement executed between issuing company and underwriter for the purpose of giving assurance of subscription. Custodian agreement. In the issue process, an agreement is concluded between the custodian and the depository. A copy of this agreement is also enclosed. Trust deed. A copy of an agreement between issuer and trustee is also enclosed. It describes the responsibilities and duties of the trustees for servicing the issue. Listing agreement. A copy of listing stock exchange agreement is also enclosed so that investors are well informed about the secondary market for the issue. Subscription agreement. As per this agreement, lead manager and the syndicate members agree to subscribe to the issue. Now let us discuss about international bonds. Bond is a debt security. The government and companies issue bonds to raise capital in the market. They can issue bonds either in domestic market and local currency or in the other market and different currencies. When bonds are issued in foreign market, they are termed as international bonds. International bonds are issued to raise long-term funds in foreign currency. The creditors receives fixed interest payment and amount at the end of specific period of time. There are different types of international bonds issued by a company. These are foreign bonds. Foreign bonds are the bonds that are issued outside the company in the currency where they are issued and traded. If a French company issue bond denominated in Swiss francs in Switzerland, it will be called a foreign bond. They are underwritten by the underwriter of the country of the issue and subjected to rules and regulations of that country. Euro bonds. Euro bonds are issued in currency other than that of the country where they are issued and traded. If a US company issue bonds in dollar in Switzerland, it will be called a Euro bond. They are underwritten by the underwriter from different countries and free from the regulation of that country. Global bonds. Global bonds were firstly issued by World Bank in 1989 and 1990. Since 1992, they are also issued by the companies. Global bonds are issued simultaneously in several markets by the high credit rating companies. Such bonds are denominated in 7 currencies, which are Canadian dollar, Australian dollar, Japanese yen, Swedish krona and euro. State bonds. State bonds are one of the types of traditional bonds. These bonds involve fixed interest rate, that is the coupon rate. Most of the state bonds are US dollar denominated. To fix the coupon rate, creditworthiness of the borrower is taken into consideration. Floating rate notes. Bonds that carry variable rate of interest are known as floating rate notes. These bonds are firstly issued in Italy during 1970. An FRN offers interest of LIBOR, that is LIBOR, plus a quoted margin or spread. The rate of interest is revised at regular intervals, usually every 3 or 6 months, to show the changes in rate of short-term money market. Convertible bonds. These bonds carry fixed interest rates and can be converted into equity shares at the specified period. In changeable conditions, these bonds prove to be safer and more protective. For the borrowers, the cost of convertible bond is less because of lower interest rate. After conversion, they help in decreasing the debt equity ratio. For the investors, convertible bond is a better alternative. Prior to conversion, they get fixed interest, and after conversion, they get ownership in a company. Cocktail bonds. These bonds are denominated in several different currencies. The benefits of currency diversification are automatically received by the investors when they purchase the cocktail bonds. Now let us discuss about issue procedure of international bonds. There are certain steps involved in the process of issuing international bonds. These steps are: as the process of issue is highly technical and complicated, the issuer, generally a government or a company, appoints a lead manager, which may be a commercial bank or an investment bank. The lead manager assists the issuer on various particulars of the issue, such as size of the issue, price, timings, maturity, and potential strength of the buyers. The lead manager also invites the co-managers to assist it in the process of the issue. After receiving the instructions from the lead manager, the issuer gets involved in preparing the prospectus and other legal documents. In designing the issue, the role of issuer's own auditor, accountant and legal counsel is very important. They design the issue considering company's financial needs and regulatory requirements of the country. Sometimes issuer also takes the advice from the lead manager so that issue would be suitable for indicators that exist in the international financial market. For such advice, lead manager charges a fee known as management fee. After obtaining approval from the regulatory authorities, issue is launched in the market. At this stage, credit rating of the issuer as well as the institution who underwrites the issue is examined by the investors. A well-recognized credit rating agency assesses the creditworthiness of the issuer. When the process of underwriting is completed, the lead manager begins the process of selling the bonds to the investors. Investors are individuals, institutions, investment trusts, banks and companies who buy the bonds through their broker network. Issuer also appoints a trustee, usually a bank, to protect the interest of the investors. Finally, listing institutions enlist the bonds for the purpose of secondary marketing. The whole process of issuing the international bonds can be completed within a span of 4 weeks. There are 7 documents that are required in the process of issuing international bonds. These are: number 1, prospectus. It contains information about the issuer, its management and about the financial health of the issuer. Political and economic conditions of the country are also mentioned in the prospectus. Number 2 is subscription agreement. It contains information about the various aspects of the issue, such as face value, coupon rate, price of the issue, maturity period, commitments of the underwriters, closing date and payment terms, paying agent and trustee names, listing details, agreement termination conditions and compensation rules in case of misrepresentation or breach of warranties. Listing agreement. It is an agreement that contains the details of listing centers. Then paying agency agreement. It is an agreement between issuer and bank that pays agent for performing duties with regard to bond issue. There is trust deed, a contract between issuer and the trustee to protect the interest of the bondholders in case of default. Then there is underwriting agreement. It is a contract between issuer and the underwriter that represent the underwriter commitment for subscription of securities. Selling group agreement. It gives details about the agencies involved in the process of selling the bonds. Now let us examine short-term and medium-term instruments. The first one is Euro notes. Euro notes are short-term promissory notes with maturity period of less than 1 year. They are issued by companies to meet its short-term fund requirements. A company can issue Euro notes in any currency other than currency of the country where they are traded. It is an inexpensive route of funding as they are placed directly with the investor public. Documentation requirements for a Euro notes issue are minimum. Euro notes can be easily structured to meet the requirements of various types of borrowers. It is more preferred by investors in view of their short-term maturity period. When the company plans to raise funds through Euro notes, it appoints facility agents or lead manager. The lead manager gives advice on various particulars of the issue, underwrites the issue and sells them with the help of placing agents. Euro notes issue involves three main cost components. These are fee paid to the underwriter, fee paid for structuring, pricing and documentation, that is the management fee, and the margin on the notes themselves. It can be either in the form of spread above or below LIBOR or built into the price of the notes itself. Various documents are required in the issue of Euro notes. These are Underwriting Agreement, Paying Agent Agreement and Information Memorandum showing issuer financial position and many other things. All these documents accompany the Euro notes. The settlement of Euro notes can be done through physical delivery or through clearing houses. The second type is Euro commercial papers. Euro commercial paper is an unsecured short-term debt instrument having longer maturity going up to 1 year. It is issued like promissory note by highly creditworthy and top-rated companies to raise funds. ECP is issued outside the country in the currency in which it is denominated. The main difference between Euro commercial paper and Euro note is that the former is not underwritten. EPC carry market-based interest rate, LIBOR, and vary in amount from US $10 million to US $1 billion or above. It is sold on interest basis or on a discount basis with no coupon payments. Similar to Euro notes, the arrangement of the issue is generally done through placement agents. In order to avoid physical delivery, it is settled through clearing houses such as Cedel from Luxembourg, First Chicago that from London, Euroclear, Brussels and Chase Manhattan from London. The advantages of Euro commercial papers are, these are cheaper source of funds as sometimes it is priced below or near LIBOR. Documentation requirements are minimum. It can be tailored rapidly to satisfy the need of both borrowers and the investors. Medium-term Euro notes. Medium-term Euro notes are debt instruments used by banks, sovereigns and international agencies to raise medium-term funds. A company can fulfill its medium-term funds requirements through the rolling over of short-term Euro notes, but it involves time and cost. Medium-term Euro notes eliminate this problem of rolling over as they are issued for medium-term funds without any need for frequent redemption and fresh issue. They fill the gap of maturity period between short-term Euro notes and long-term Euro bonds as their maturity period ranges between 1 year and 5 to 7 years. They are issued at fixed or floating rate of interest. Normally, they are not underwritten. A provision is there to ensure that borrowers that they get the funds even in case of insufficient creditworthiness. Now let us summarize this module. To sum up, we can say that international securities market is an important component of international financial market. A borrower can obtain long-term, medium-term and short-term funds in international securities market. A company can raise long-term capital through the issue of international equities. International equities are the ordinary shares issued outside the issuer domestic market in the form of ADRs and the GDRs. International equities provide benefits to the issuers as well as the investors. In the process of issuing international equities, the role of lead manager, custodian bank and global depository is very important. A large number of documents are required in the process of issuing international equities such as prospectus, depository agreement, underwriting agreement, custodian agreement, trust deed, listing agreement and subscription agreement. International bonds are issued in foreign market to raise long-term funds. International bonds are of different types such as foreign bonds, euro bonds, global bonds, straight bonds, floating rate notes, convertible bonds and the cocktail bonds. To issue international bonds, issuer approaches the lead manager who gives advice on various aspects of the issue. After obtaining approval from the regulatory authorities, issue is launched in the market. When the process of underwriting is completed, lead manager begin the process of selling the bonds to the investors. Euro notes are short-term promissory notes issued in any currency other than currency of the countries where they are traded. Euro commercial paper is an unsecured short-term debt instrument issued outside the country in the currency in which it is denominated. Medium-term euro notes are debt instruments issued to raise medium-term funds. They are not underwritten.